GM. This lesson is all about pivots. So I'm going to break it into two parts. The first part being the actual definition of what pivots are. There are things called pivot points, which are calculatable levels that you can get on a chart, and it is a well-established and has been widely used in price action and technical analysis for decades. So it's a real thing. I haven't invented it. I haven't invented fucking anything. The only people online who pretend they invent stuff are bullshit marketers who are trying to sell you some shitty trading course or some $4,000 fucking indicator. Right? There's nothing new in the markets. Millions of people have traded before me, millions will trade after me, and billions and trillions of dollars flow around every day. There is nothing new that hasn't been studied. So with that being said, I also use the term pivot differently, but it's the same kind of idea, right? What is the point of it? It is supposed to be an extension of support and resistance. The whole basis of trading really is trying to find high probability areas where price is going to react. Yeah? It is not about knowing where the market is going to top and knowing where the market is going to bottom. Right? It's very common, right? And if you think that way currently, it doesn't mean you're a bad person. It's very normal when you start trading to think in terms of, I want to know where the top is, I want to know where the bottom is, because I want to buy low and sell high. You don't need to do that to make money. In fact, the quest for buying low and selling high has led more people into being broke than actually making money. The goal is, can I spot areas that have a high probability of producing a strong reaction? And then, can I have the mental flexibility to understand that I can go long or short at that level? Assuming you can do both, okay? If you're somebody who doesn't trade short for religious reasons, or maybe because you live in a country that doesn't allow futures exchanges, then cool. Just use the long side, right? Same principle applies. I want to identify high probability areas where price is going to make a big move. So, what are actual pivots? On the screen, you'll see an image. This image is from TradingView, which I will go to in a moment and show you the actual indicator. There is an inbuilt indicator in TradingView that maps these pivots out for you. Okay? Pivot points, they are technical indicators. And they're just an extension of support and resistance. Right? It's a way of finding a level and then overlaying some support and resistances above and below it as potential areas for price to react. And they're useful as a quick gauge for market sentiment, which I'll explain now. Where do pivots come from? They were developed by floor traders on the equities and commodities exchanges. So you might have things like the CBOT, Chicago Board of Trade, New York Stock Exchange, Chicago Mercantile Exchange. Back in the day, before all this electronic trading or flipping shit coins from your bedroom, people actually went to work as traders. They actually went into a building and screamed at each other for 7 hours a day trying to buy and sell stuff, as you can see on the screen there. Right? Fucking punching and elbowing and hitting each other and all wearing bright shirts so they could be seen. I get massive FOMO every time I see these things. It would have been so G to actually do that back in the day, back in the 80s when it was at its peak. But pivots came out of the pits, which is the floor. And the idea was to have a quick way to calculate potential turning points for the next day, right? Anyone who traded, or at least the vast majority of floor traders, they were just trading day to day. They were the original day traders, intraday. And a lot of it was just off the top of their head. And they're just looking at price quotes. If you see around there, there's no fucking charts, right? There's no trend lines, there's no indicators. It's just boards with price quotes on the wall and people screaming numbers at each other. So you had to be an extremely quick thinker and you had to make decisions on the spot. And not just one or two. You can't just take one or two trades. Some of these guys were taking hundreds, if not thousands of trades per day. So the pivots come out of that. And the reason that they have so much validity and they've stood the test of time is because of that. It wasn't some bullshit marketer who said, I'm going to slap a name onto something and say, here's my secret system. It came from a collective origin across decades of thousands, if not tens of thousands of different traders all using them. So when something is so widely used and stands the test of time, it is much more likely to be good, to be useful. Now, does it mean it's the holy grail of trading? Absolutely not. Just like any indicator, any strategy, any price action concept, it is riddled with inconsistencies. And of course, used in the incorrect way, it will make you fucking no money or lose you money. So, why do we use them? Or why do traders use them? It's just to project support and resistance, right? SR, support resistance. And it allows you to anticipate potential areas where price might react. And notice that. Notice how I never speak in absolutes. Potential areas where price might react. It is not magical line go boing, and as soon as it hits, I'm just going to get maximum short or maximum long because the magical line has to work. They are based, though, off of market psychology. And they can be self-fulfilling to an extent. Because if you see something like, for example, a very strong weekly candle, the traders in the following week are going to put more emphasis on that week's levels. Right? And I will get into in a moment how you actually calculate a pivot and the S's and R's that come off them. But understand, they are a derivative of past price, just like pretty much everything is in price action. So if you've got a daily pivot level, that will be based off of the previous day's price. The high, the low, and the close. Those are the three inputs. So you take the high price, the low price, and the close price of whatever candle it is, whatever range you're looking at. You can do daily, weekly, monthly, you can do literally anything you want. So the reason it was so valid and so useful for those traders on the floor is because when you come in on Tuesday and you're trading just on Tuesday, and on Wednesday you start over again, and on Thursday you start over again, then when you come in on Tuesday, what do you care about? The thing you care most about on Tuesday is what happened on Monday, right? Because you have to start somewhere. So the first thing they're going to look at is what was the high of yesterday's candle, what was the low, and what was the close, right? Now it doesn't have to be a candle, it's just prices. The high of the day, the low of the day, and the close. Those are the three levels they start with. Then the pivots come as a derivative of that. You take those levels and you can create further levels, S1, S2, S3, R1, R2, R3, in order to project if price does move up, where it might go to. So, how do you measure them? So here's how you measure them, and I'll kind of give it a brief overview, and then we'll dive in a bit deeper into it. You got the standard formula, right? The standard pivot point formula, which is the pivot is equal to the high plus the low plus the close divided by 3. Right, very simple. If Bitcoin had a high of 30K on a daily candle, a low of 29K, and a close of 29.5, you would add those three up and divide it by 3. Yes? That's how you get it, right? That's your pivot. And so you can do this. You can go to any candle you want, calculate it up, and draw a line across whatever the result is, and that is your pivot. Yeah? Okay, cool. So, support and resistance levels. So when you get this pivot, that's like your mean, right? That's the mean, the average price. And so you want to then have some deviations from that, just like in many other tools. You'll notice that pretty much everything in the markets, certainly in technical trading, is about some type of mean, right? It is about price coming to historical levels or based off historical levels and returning to some type of mean. It's all from a concept or from a base level of behavioral economics and market psychology. Traders, be that a small trader trading in his bedroom or an institution, doesn't matter if they're retail or a fucking billion-dollar hedge fund, they often set orders at round numbers or historical price levels, right? 20k Bitcoin means more than 21,346. And that's the same for you and me and for fucking Paul Tudor Jones or George Soros. It doesn't matter how big or small you are, those round numbers have more meaning. Likewise, the most recent price also has more meaning. So whether it's an exact round number, it doesn't matter. But if it was yesterday's high, if it was the highest point of yesterday's candle, if it was the lowest point of yesterday's candle, if it was the daily close, those levels matter. And so because we know this, we know that every trader takes these numbers into effect. They consider them. Do they all trade based off them? No. But do enough of them take an opinion on them that it is self-fulfilling? Yes. Yeah, so that's in essence why they have some validity or where they're useful. Okay? And then you're looking at this point and you're saying, what's this support resistance? What is this? What is this S1, S2? What is this R1, R2? And so on. Well, support and resistance, you get your S1 by doing 2 times your pivot point minus your high. Right? First resistance is the exact same thing, except it's 2 times your pivot point minus your low. Your S2 is your pivot point minus your high minus your low. Your second resistance, R2, is the opposite. And then you can also go to S3 and R3 if you want, which is the pivot point minus 2 times the high and low, and pivot point plus 2 times the high minus low. Right, I'll gloss over those. You don't need to, it's probably confusing, right? But it's actually very simple. And I'll gloss over that purposefully because it's not, you don't need to get bogged down in the numbers. Let's talk about the logic instead, right? Instead of all these calculations, let's look at the logic behind it. The logic is rooted in the market's tendency to revert to the mean or to an average price after making swings higher or lower. Right? So the pivot point represents the mean, the average price, which serves as a baseline for that period. The first levels create a symmetrical range around the pivot. So those are your first levels to look at. Those are your immediate levels for potential reversals. Yes? Your second levels are taking the full range of the pivot candle. So if you imagine your daily candle, right, of Bitcoin that I said was 29 up to 30, right? The low of the day was 29, the high of the day was 30. That's a $1,000 price range. Okay? And so your S2 would be an exact $1,000 price move above the pivot. So if your high of the day was 30, your low of the day was 29, and your close was 29.5, your pivot would be 29.5. Right? Your S2 then would be $1,000 off of 29.5, which would be 28.5. Your R2 would be 30,500. It takes the daily range and adds it or subtracts it. This is the same as a 1 standard deviation move. It is not mathematically the same. It is the same logic. It's the same concept, right? So if you've studied any other type of price action, you'll have come across the concept of standard deviations. Or if you've done maths in school or university, you'll understand this as well. Third levels are more extreme because they're further away from your mean price. So they are more similar to a 2 standard deviation move. And as the names would suggest, the further you deviate away from that pivot, from that level, the more overextended it becomes, the more potential there is for a reversal, and the less likely it is to continue moving in that direction. Right? So, the S2 is the pivot point minus the full range of the pivot candle. The R2 is the pivot point plus the full range of the pivot candle. And the S3 and the R3 is the same thing, just times 2. Right? So it's 2 ranges away. Now, when you're talking about these means, and why does it matter? Why does mean reversion? You probably hear this term a lot. I have lessons on it. We talk about it a lot. Mean reversion is it's a foundational concept within the markets. Many analysis methods, so many of them, rely on some type of mean concept. Because the whole idea of markets is about valuation. Markets exist for buyers and sellers to meet, to exchange goods or services at a fair price. That's what a market is. whether you're selling fish or wheat or corn or Bitcoin, right? There's a buyer and a seller, and they come together and they agree on a price and they exchange. So at all times, price is trying to find fair value. It's trying to find a level at which buyers and sellers are willing to meet, and it wants to find a level where the most buyers and sellers are willing to meet so it can do the most trade. That will be known as the fair value, but there's no such thing in real terms. There's no such thing as a fair value because price is always moving, especially in crypto. So if you've ever used a moving average,